Hello and welcome to MF Corner. I'm Sumaira Abdi. On the show today, Mohit Gang, co-founder and CEO of Moneyfront, answers the question that everyone has on their minds: why are actively managed funds underperforming? Also, a little later, Kshitij Mahajan, co-founder of Complete Circle Consultants, tells us whether our portfolios need some exposure to sectoral funds and how much. All right, first up, let me welcome Mohit Gang, co-founder and CEO of Moneyfront. Hi, Mohit. The underperformance of active funds has now been talked about a lot, okay? But there seems to be no conclusive reason as to, what's behind it. Is it just that, the fund manager has not been able to perform, or is there more to it?
Okay, so look, I think there are multiple factors which kind of contribute to the underperformance of actively managed funds. If you look at just the first part, which is the cost part of it, the expense ratios of these actively managed funds, there was a Morningstar study in 2019 which said that the weighted average expense ratio across all equity funds was 1.93%. If you go to an index fund, right, which is a passively managed strategy, the expense ratios are as low as from 10 bips to around 30 bips, right? So there is a gap of almost good 1.5% on the expense ratio itself, which the active fund managers have to beat every year. That's point number one. Point number two, SEBI a couple of years back also introduced this concept of TRI index, right? Previously, the benchmark was a PRI, which is a price return index. And now the fund managers are required to beat the TRI index as the benchmark. So they will be compared with Nifty 50 TRI, a large cap category, right? So TRI will include the dividend yield of the Nifty, and dividend yield of Nifty in itself is around 1.3% 2019. So a cumulative effect of cost and dividend yield will roughly tend to amount to around 2.25 to 2.5% kind of a number. For an actively managed fund to beat an index fund by that kind of a margin is a fairly Herculean task, honestly. If you see the last 5-year performance of all the large cap funds, the return in the category has hovered between 7 to 11 odd percent. If you see that they have to beat the index by around 2.5%, which means a good 20% outperformance year on year. To my mind, that's very challenging and very tough. And that's where the entire equation has been crumbling for active managers.
Okay, so Mohit, the question then is that, how much of this underperformance is because of these factors, like you mentioned, which is cost or the change in the benchmark index, and how much of it is just basically stock selection gone wrong? I mean, what I'm trying to gauge is that should we stick with the active funds that we have in our portfolios, or I don't care what is the reason it's not performing. If it's not performing, should I just ditch it and move out?
Look, so I think we've been very clear on the large cap side. There is a merit for each investor to move to index funds or the ETFs. Honestly, I think the cost equation, the return equation is very much in favor of the index funds. Just to give you a small example out there, a normal active fund is restricted as per norms to not invest beyond 10% in an individual stock. Right now, the weightage of Reliance in Nifty itself is around 13.6 odd percent, which means today every large cap fund manager is underweight Reliance as compared to the index. Now, if you're underweight Reliance for last 1 year, there is no hope in hell that you could have outperformed the index, right? So these are some structural challenges which the large cap fund managers are facing. And there is one more challenge of SEBI categorization of schemes. Now, each fund house can have only one scheme, which means that the large cap schemes have become extremely big in size. To manage a scheme of around 15,000, 20,000 odd crore AUM, they need to have around 60 to 80 stocks, which means they're virtually buying the entire index because they're restricted to buy 80% of the portfolio from top 100 stocks. And there is very limited ability now available to them to go beyond that top 100 stocks and figure out reasons to generate alpha. So that's where the whole problem is. Our sense is on the large cap side, yes, move to index. On the mid and small cap side, there is enough and more opportunity. Fund managers have generated alpha out there. They continue to do great work. The active fund managerial talent in the country is quite deep out there. And the universe is also vast. There are enough opportunities and the schemes are of lesser AUM. So out there, we still feel that an actively managed strategy can work well.
Okay, so what you're saying, and I'm just going to paraphrase it, is that on the large cap end of things, it's better to go with a passive strategy, which is an index fund ETF route. And where in the mid and small cap universe, where you actually require that skill set to, differentiate between the good and bad, it's better to go for an actively managed fund, right?
Absolutely bang on. Look, I think globally that's been the trend. In US itself, the passive strategies have overtaken active fund managers. So the US mutual fund industry has now 50.1% of passive funds, which is index and ETFs, and 49.9% active funds. So globally, that's been the trend. In India, the composition is still 21% for passive strategies, and our sense is it will keep increasing as time passes by. Like, look, so index funds are like wolf packs. They will continue to weed out underperforming fund managers and weaker strategies which are run on high cost and consistently under delivering, right? So, and those structural challenges, typically because of regulations, because of scheme classification and categorization, these are too much to bear with. And the cost structure obviously can't be reduced because there is a distribution structure to be incentivized. So a whole combination of these factors will always work against the active strategies. And that's why it's better to have active strategies, passive strategies in the portfolio by form of having index funds.
I got it. Mohit, let me just refer back to the recent multi-cap issue that happened, right? And I'm going to sort of try and make a connection over here. Is that the fear was when SEBI said that, there must be 25% in mid-cap and small cap, the fear was that there would be too much money chasing stocks, and there weren't that many investment opportunities, right? Now, the same for, say, a biggish mid-cap fund, right? If the call really is that you move out of the actively managed large cap space and you move in to a passive strategy, then you have the marketing geniuses then pushing the mid cap funds. At what point will the same strategy which we're now applying to large caps also come into the mid cap fund space, right? Because at some point ideas will run out. What do you do with the amount of incremental flows, especially that the larger mid cap funds see? There aren't that many investment opportunities, and likewise for a small cap fund, right?
Absolutely. I think this is problem of scale. Honestly, as you move up the curve, as the mutual fund industry matures in India from 27 lakh crores to 50 lakh crores, I think the transition will be very painful for active fund managers. Today, the universe for mid-cap stocks is from 101st stock to 250th stock, and for small caps is 251st to 500 stocks. So they have 250 stocks each to pick from, which is a fairly large basket. And the good part is the mid and small cap categories are small in the country today. Like a large cap category is 1.5 lakh crore, a mid and small cap categories are not even 1/3 of that size. So there is enough scope for that kind of an allocation to flow through. But as the categories keep going, investors will have to keep this in mind. As the fund sizes increase, the overall value and the volume increases, they will have to move to passive strategies out there also. But as of now, I think there is enough latitude available to fund managers between that universe of 250. And also the good part is, Sumaira, SEBI doesn't compulsorily ask you to invest 100% in mid-cap stocks, right? The categorization is such that they still have needed to go some bit into large caps in both mid and small cap segments. So that kind of gives them a good cushion. So they are completely full up on the large cap sides, even the mid and small cap schemes. So they play around with that. But vice versa on the large cap, they don't have so much leeway. They are 80% loaded in the large cap names, which are the good quality blue chips, which is almost like hugging the index. And then there is very little latitude for them to figure out opportunities to outperform the index.
Okay, so therefore, just one final question in terms of size. See, large caps, you've already sort of given the view that, a passive strategy is better. Small cap, I guess an active strategy would always be better because, things develop also over time for promoters and companies. On the mid cap end, what's a good size or an ideal size that an investor should see? Should they avoid very, very large schemes? Should they go for more boutique schemes, which are, more thought driven, more value driven? What should they look for?
Oh, yes, absolutely. I think it's better to avoid mid-cap schemes, which are, let's say, around over 10,000 odd crore kind of an AUM. those are too bulky and big. I think the nimbleness of the fund manager kind of gets restricted out there. So it's better to stay put with schemes which are near that 5,000 crore mark zone. You have enough and more opportunities out there. And you can deploy it smartly without distorting or without increasing the tail of the fund, basically. So tail of the fund will mean that last 20, 30 stocks, which are very minuscule composition, they kind of distort the return. So if the scheme is very large, the tail is very long. So a small fund kind of restricts the tail, which is very important to generate that additional return for fund managers. So mid cap and small cap, I think there is some time to go for the markets. The maturity of the market will take some time. And on the large cap side, yes, I think index fund deserves a merit in every portfolio.
All right, Mohit, thanks very much for joining in. And, I hope that we've been able to shed some light on people who have been, very, very upset with the underperformance of their actively managed schemes. And thanks very much for watching MF Corner. Do stay tuned. The news continues on CNBC TV 18.